Thanks so much for tuning in to Talking Point. I'm your host, Niraj Shah. The case for a chat with our guest, Vinit Sambre, today. Is promoter selling a cause for caution or not really? I think it's one of the key questions that has been weighing on the minds of the markets in the last few quarters. Is quality making a comeback? Remember, everything from an HDFC Bank to a Page Industries has rallied between 15 to 20% in the last 2 months. And is the BFSI, with the BFSI valuation discount at a record high, does BFSI become a pocket that you might want to focus on for incremental investing? Vinit Sambre, Head of Equities at DSP Investment Managers, joins us right now on the show. Vinit, thanks so much for joining in. Really appreciate your time. How are you approaching markets currently, Vinit? As of end of August, you and your brethren together hold about 1.48 lakh crores in cash and cash equivalents. Have you been on the higher side? Have you been cautious? Or have you been fully invested and are you enjoying the ride?
So thank you, Niraj, and good morning. I think we have been almost fully invested. We haven't sort of changed course in terms of taking a call on the cash. Because I think broadly the assumption with which we work is investors at their end need to sort of take the cash call, and when they are allocating capital to the funds, I think it is our responsibility to sort of remain invested at all points in time. Cash at sometimes maybe more strategic in nature to have some ammunition ready to at opportune level to buy, but broadly we don't take large cash calls as such. And the other than that, I would say that this huge amount of cash which is there in the system at the fund level, at the retail level, there is a lot of optimism. Foreign investors, they want to be part of the India growth story. Maybe they are also waiting for decent valuations. That makes us feel that the market itself should not see deep cuts unless there are some events which leads to that. But other than that, that being the case, this kind of high valuation is something which we'll have to live with at this point in time. Just that in terms of our strategies, we just try to look at the relative valuation across different segments, cycles of the business where we see, let's say, some improvement in the cycle taking place and valuations being reasonable. I think it is more an allocation to those categories. So I think that's how we are sort of trying to navigate the current situation.
Noted. Vinit, what's your view on this very popular way in which people look at the recent developments, which is if promoter is selling or if a PE investor is selling, that's a word for caution because the promoter knows the business best more than anything else. I mean, this has now continued for 12 months. If it turned, I mean, you could argue that this is an anomaly if it lasts for 1 or 2 or 3 months, but over 12 to 18 months, we've seen promoter selling coming in a big way, and the markets are certainly higher and those individual pockets are way higher than what they were when the sales happened.
Absolutely right, Niraj. I think if I go back in history, generally this kind of promoter selling, this magnitude of promoter selling, ideally is generally is showcasing the tipping point in the markets that markets are high. The promoters also feel that the valuations for their businesses, which the investors are ascribing, is generally reached a point which doesn't look like sustainable, and which is where the promoter selling sort of takes place. Now, in the past, these are some of the, let's say, signals which one picks from the market, suggesting that markets could be near the tops. But I think, like you said, this time around it has sustained for a longer period. All what has been sold by the promoters in the last 1 year, the stocks largely have seen significant improvement only because it has got absorbed from the huge liquidity which is coming into the markets. And I think this could sustain till the time there is demand, there is money which is floating around, and that keeps chasing good quality businesses. But the point, at some point, maybe, we'll reach a point where the supply sort of overtakes the demand, and that's where maybe people will start cutting positions from their existing portfolios, and which is where maybe we'll see some more, let's say, cuts or consolidation.
Okay, but so Vinit, my question to you, okay, I'm just trying to gauge, sorry if I missed it, but uh, do since they are still happening, is that a concern or is it a case-to-case scenario? Because there are large blocks happening as we speak today as well.
So it is a case-to-case scenario. I would say that companies which are making sense from the investors' perspective, promoters needing capital for growth. I think those are good spots because that is providing opportunity for investors to also participate. It is increasing the free float and thereby maybe giving slightly more brownie points when it comes to valuations. And if the promoters are putting that capital to work and are ready to sort of earn reasonable ROCs from those, I think those are good spots. But where we have seen that there's a lot of narratives which have been built around businesses have reached 40 levels of valuations. There is a lot of exuberance and their P or promoters are trying to encash and investors are still lapping up. I think those are the risks to us, and maybe at some point those will emerge out as risk. So it is case to case, and one will have to evaluate on individual basis for each of them.
Got it. Okay. Vinit, are we egregiously expensive, or do you reckon these valuations can sustain?
So I would say on the first point, we are expensive. I mean, there are a few pockets which can show reasonable valuations, but for a reason. And the ones which are expensive, I think they've gone beyond their reasonable limits. If you any cuts, you look at it 5-year, 10-year average valuations, we have been crossing. And incrementally, Neeraj, what is happening is that whichever sector actually comes into fancy or suddenly catches the attention, the re-rating sort of takes place very quickly, and as I said, it crosses its all the historical averages. So I think this is a power of money flow which is there, and one from that perspective, if you ask me that is that a reason for being cautious? I think so. The reason for caution is more around how one is thinking about generating returns or the expectations around the market, and if one is actually trying to sort of get swayed and is largely getting stuck in narratives or fads, I think those can eventually hurt in the long term. I think those pockets are which where investors should sort of remain slightly more vigilant is my guess.
Okay. Okay. Vinit, so the most common saying or mention these days is about how large caps are still maybe okay in terms of valuation, but there is froth in mid caps and small caps. Now we know that it can't be uniform because it's a very wide bucket. Two questions. One is a tactical question, one is a bottom-up question, that which are those pockets out there at the broader end of the spectrum where you believe that valuations relative to growth that they present are still attractive. Part two of my question is this, that if indeed we know that when the mid caps and the small cap as a pocket correct, even the good ones are taken down with the receding of the tide. So do you foresee that to happen, or do you believe some of the strong promising stories may withstand the pressure?
So, Neeraj, I think this time around it has been slightly very different. I can say the businesses which we consider defensive, we are seeing that in drawdowns they may be sort of taking a higher hit as well, and this is to do with the that flow of capital which is chasing the momentum at that point in time, and we have seen progressively the sectors have been rotating and the money is chasing those and just maybe taking money out from the other sector. So there is no fundamental pattern or fundamental connect to what is happening today. But broadly, if you ask me where are the pockets of opportunities, I would say that maybe excluding banks today or insurance maybe to some extent, the valuation ranges have gone up. Now, let me sort of try to sort it as per the degree of valuation. So in terms of the where we have the highest comfort given the growth matrix, I think healthcare is where while the valuations have moved up, but it seems that the growth is intact. More is sort of coming to the segment. The US market is improving. The Biosecure Act is providing more opportunities for some players. So I think that is where I would say that while valuations have gone up, it is not exaggerated, is what I would say. That is one pocket. The other pocket may be the building material broadly as a category. I mean, this is I'm talking from the broader space, like you asked, is one where we have still not maybe seen the benefits from the higher real estate sales which has happened, and maybe those should sort of start coming through, and those are the segments which could match maybe or sustain the valuations what they are currently trading at. Um, I think broadly, and likewise, I would imagine that the automobile industry is one which is seeing a lot of technology related change, and we are seeing that the as a whole the industry has been on a launching spree. New models are sort of coming up, and that is going to create a decent demand pool, even if it is, let's say, mid single digit demand pool. What it will do is it will create more opportunities for the auto and companies, and which is where we see that maybe the growth visibility should be okay, and hence the maybe the higher valuation sustains. But there are spaces where which have picked up quite a bit in the last couple of months. Let's say the energy transition theme, the renewable theme, a lot of this, the EMS theme, it has caught fancy on the hopes of very high growth. Maybe it does see high growth, but the kind of valuation stretch we are seeing seems slightly, unreasonable to us. Uh, if it outperforms the kind of growth what the expectations are, maybe that then it sustains. Otherwise, that we see those as a risk basically.
Okay, well, Vinit spoke of the Biosecure Act and pharmaceuticals certainly in the thick of things. In fact, it's a bucket that you want to watch out for idiosyncratic movers as well as bottom up. Vinit, we were talking to Syngene, and I'm just trying to delve into 3 or 4 sectors. We were talking to Syngene earlier, and they mentioned that, like everybody, that this is a longer term theme, but it sits on top of the existing process of manufacturing and research moving eastward, and China plus one giving that opportunity to India and other country pharma companies to stand up and get noticed and get business. You guys run a very successful healthcare fund as well. I would love to know how you think about healthcare, but predominantly the CDMO CRO pocket.
We are pretty much convinced, and healthcare has been our long-standing positive category. If we look at not just the healthcare fund, but across different funds, we have been slightly overexposed. Now, in some funds, we've started taking some profit out given the valuations. But I would say that this is one sector which has a good combination of, let's say, sustainable growth between 11 to 15%, good cash flow generation, decent ROCs. And a while back, the valuations were also very supportive of looking at the category. Now, coupled with that, I think the sector itself has gone through a bit of a low cycle post-COVID, where the US business in general was constrained, and I think that is now picking up through the last 3-4 years as the Indian companies went through a very tough, cycle of their plants getting examined by the US authorities. I think the quality of the plants have also sort of is improving and will give a boost to the business momentum eventually. What I would like to say that while the Biosecure Act or the CDMO opportunity, it is definitely a good long-term opportunity. But more importantly, I think the capability of the companies here is something which is a strong point for us. Companies are capable. We are good in terms of our understanding of chemistry skills. Now even the bio skills. So I would say that is an important element. The other element is a cost. And like you said, the macro is also turning positive, where companies globally want to look at businesses beyond, let's say, China. So I think all this sums up into a good position for the sector, and maybe one can take a slightly longer term view here, 4 5 years at this juncture, and hence I think that sector remains in a positive spot as far as we are concerned.
Got it. Okay. Just before we dwell on others, I think pharma is in news for more reasons than one today as well. There are, excuse me, there are specific companies which are already showing signs of this. Neuland Labs is a company in focus. Let's get in my colleague Varsha to really talk about what's happened here, because there is a CDMO aspect to Neuland's move in today's session. Varsha, tell us about this.
Well, thanks Niraj for that. So yes, Neuland is buzzing now because US FDA has approved Bristol Myers, that is BMS drug, which will be used to treat mental disorders, and the name of the drug is CAR-XT. Now this is a drug developed by Karuna Therapeutics, which is a BMS company. Why Neuland is in focus? Because Neuland has been partnered with Karuna Therapeutics since CAR-XT's phase 3 trials in 2019, and the Bristol had bought Karuna in Q3 FY24 for $14 billion, and Bristol has marketing exclusivity rights for CAR-XT for 5 years and a patent period that's much more longer according to analysts. Now analysts also peg, if you see the revenue potential for this product, so CAR-XT's peak sales during the patent period could be around $7 to $10 billion. Now also this FDA's approval was based on data from 2 studies in which patients on the drug experienced a meaningful reduction in symptoms. Now Q3 FY25 onwards could see a huge ramped up for Neuland CDMO's revenue for CAR-XT as Bristol starts launching the product. Let's see what Goldman Sachs has to say about this. So they've raised the target price. The target price has been set to 9,100 with 47% upside potential, and they expect Neuland's revenue to grow at 13% CAGR for the next 5 years, mainly driven by increase in outsourcing penetration and market share. And they expect Neuland top line growth of around 24% in FY26. Now this on the back of expansion of the Unit 3 and also commercialization of CAR-XT, which we were speaking about, and also because of launch and approvals of the newer niche molecules in specialty API segment as well.
Okay. Thanks a lot for that. So that's as far as Neuland specifically goes, but just interesting to see that some of these things are happening. Varsha, thanks for bringing that to us. The other aspect, Vinit, is how does somebody who manages such large pools of money think about such a heavyweight sector, which is IT? It's blowing hot, blowing cold. Accenture's supposed commentary led to the stocks coming off their peak in the last 3 weeks. Suddenly, Accenture's performance and guidance is leading to some bit of green shoots here. How do you think about all the volatility, one, in IT, and how do you think about the slightly medium-term picture? Is it a sector that is providing an investable opportunity?
So I think first of all, as compared to all the sectors, maybe the kind of information which gets available to the analyst community in the IT sector is the highest. I mean, to the accuracy of maybe 2 decimals is what people are sort of feeded with the information, and hence the volatility around the quarterly numbers, the misses and maybe outperformance actually leads to a lot of volatility. But like you said, I think slightly stretching beyond these quarterly noises, if one is thinking about the long-term opportunity, I think we are at a juncture where maybe we were 5 years back when, from pure coding and the other stuff, we were sort of moving to digital and the cloud-based opportunity. And it was sort of felt that whether Indian companies will be able to make up into the new segment as such. I think today also we are at that same interesting point where the AI piece is something which is again sort of being has come up, and the question mark here is whether Indian companies will see benefiting, or where a lot of these efficiency gains would mean that there will be attrition and less people requirement, and the business will come down. So I think this is call to be made, and I think it's very difficult to predict. But the way I think is that Indian companies they have, again, it's about the skill set. The Indian companies does have the skill set. We are low cost, source for the global players. And I would say that even in case of AI, while the lot of efficiencies will be there, but the quantum of work is also going to expand significantly, and which is where we believe that this is also going to eventually lead to decent growth for the IT sector. Time and again, I think the sector has proven their skill set in the newer technology, and they have taken up that as a challenge and grown. So we would like to go by the historical trends and say that this is going to be the new avenue for growth for the sector. The sector has all good metrics when it comes to ROCs, cash flows, dividend payout, governance, and hence the quarterly noise could become also could be also taken as an opportunity to sort of maybe look at sizing your bets at that point in time to maybe benefit from the long-term growth opportunity which we see coming to the sector.
Okay. Vinit, are you bifurcating between IT services large cap, IT services mid cap, or ER&D or product companies? Are you bifurcating in IT that way? And is there a first amongst equals?
Yeah, it used to be bifurcated previously, where the mid cap used to be trading at a discount to the large caps. Now it is the other way around, I think, and for right reasons, because they have shown maybe more sustainable and higher growth trends. And also, in fact, Neeraj, if you go back and see, I think whenever the companies reach $1 billion sales, that is a sweet spot. It allows them to get into the bidding process much more, and the journey from 1 to 2 billion is a higher growth journey and slightly more linear growth journey, and which is where large part of the mid cap IT companies which are there today are seeing the benefits of that. So I would say that we have to bucket them into large and mid, given this fundamental difference, and also the valuation difference is there, and hence from that lens is what we are also sort of taking a call and not ignoring a mid cap IT just because the valuations could have been on the high side.
Okay. Noted. Vinit, the other key question is what to do with banks. No longer can we say that banks have been underperforming, because the last one odd month, I mean, HDFC Bank, some of the others too have gained anywhere between 10 to 20%. But there is a rally that has happened already. We're not quite still seeing signs of private capex. And a lot of economists recently that we spoke to mentioned this possibility that if indeed there are severe Chinese tariffs, then those goods, final goods, could be dumped into Asian emerging markets as well. And therefore, private entrepreneurs might think twice before setting up very large capex in the near term because of this China risk. So if private capex is getting delayed for whatever reason it may be, do banks still provide a good opportunity to invest, or would you bide your time because there are other opportunities?
No, so I think first and foremost, growth is one aspect as far as the banks are concerned, which is going to get driven by the government capex, the household capex, and the private capex. And I think today there's a good support coming from the government capex. Maybe the household capex is also the retail. I mean, is something which is anyways doing okay. Private capex, hypothetically, if we assume that you don't see a high growth, I think still if the economy keeps growing at 6.5 kind of a rate of growth, we will still have around 12-13% kind of the credit growth in the system, which is sustaining even now after rising to 15-17%. We have seen some bit of moderation, which looks like sustaining. Now the good part is that we are at the low cycle of the private capex. We are at the low cycle of the broad consumption in the economy, and hence that could be taken as a low point. And as these improve, these are large proportions of the economy, and as these improve, I think we can see marginal upsides. That is number one. Number two, I think more importantly, in terms of the banking stocks performances, they have been, while the banking businesses have gone through a massive, growth cycle over the last 2 years post-COVID, But the stocks have not reacted to similar extent because these were sort of over-owned, and a lot of the money which moved to other sectors, maybe I would imagine that has come out from here, and hence it has not been able to participate. Now, at this juncture, where the banking balance sheets are in the best position, we are sort of now staring at, like you mentioned, some bit of moderation in growth, NIMs picking out, the asset quality, some stress sort of emerging from few pockets, unsecured, micro, and all of those. So I think till the time these headwinds are there, maybe the stocks could sort of consolidate. But I would say from the valuations viewpoint, these are trading at reasonable valuations, and maybe the cycles, few segments of the cycles, as I mentioned, are at the low point, and hence this could become a good category to be in with a longer term. But again, be mindful that we would want to focus on banks which have very strong underwriting process, because this is something which can lead to good success or failures eventually as investors.
Noted. Okay, Vinit, great talking to you as always. Thanks for taking the time out and being with us. Really appreciate your time.
Thank you so much.
That's all time that we have on this edition of Talking Point. Viewers, thanks so much for tuning in.